Against the backdrop of the latest G20 session, Policy 4.0 published a report, and it's slated to be the first in a series on crypto contagion. I understand that to be the case, Tanvi. Before we proceed to today's discussion, let me introduce you to our team leader at HKU's RegTech lab, Professor Douglas Arner. He's the Kerry Holdings Professor of Law at HKU. He's also an advisor to Policy 4.0 and a co-author of the report. He'll deliver an overview of the report's findings.
Across 2022, the crypto ecosystem was the subject, the center of a variety of crises and collapses, including probably most spectacularly, the failure of FTX and its sister companies, Alameda and others across its group. This is caused billions in losses to investors all across the world and raised real questions about the future viability and, of course, about the future regulation of the crypto ecosystem. And in a new report released with Policy 4.0 in Bangalore, India, my colleagues and I are very happy to look in detail at some of these issues. And in this new report, we spend time analyzing not only FTX, but a range of other collapses and crises, particularly in the crypto winter, but really across the entire evolutionary history of the crypto ecosystem. And largely, what we find is the emergence of not only centralization and scale, the exact opposite of what one might think of in the context of a decentralized ecosystem, but also the buildup of a range of interconnections and interdependencies, not unlike the sorts of interconnections and interdependencies which were very much at the heart of the global financial crisis in 2008. And we argue in this report that from the standpoint of making crypto work better going forward, it's necessary to take into account the realities of these concentrations, of these emergence of large firms, and of the emergence of interconnections and interdependencies from a standpoint of regulation, and the need not only to very strictly protect against fraud and other forms of misconduct, but to build better disclosure systems combined with appropriate levels of licensing to help markets work better.
So with that, let's dive into the questions and hear from both of you as to what were some of the features of the crypto contagion that really stood out to you from a policy analysis perspective.
Yeah, thanks, Ajay. And it's a pleasure to be here on the podcast today. I think this whole episode of the crypto winter, the crypto contagion, was very unprecedented in all the booms and busts that crypto has gone through till date. So I think in the past, we've seen a lot of collapses in crypto. They're very frequent, whether it's Mt. Gox or it's, a lot of other entities have gone bankrupt, but you've never seen such a cascading scale of failures, right? So what's very important to understand is just what was so different this time, right? And what were the reasons why, the collapse of something like FTX has had such far-reaching repercussions that till date, we don't know the scale of collapse it's created, right, across the ecosystem. But, if you go back some years and there was a failure on something like Mt. Gox, that didn't really have these reverberations, right? So, I mean, there were issues like that. There are also smaller actors in crypto, which became very significant, honestly, as causes of the collapse, which are frankly not really being discussed in the regulatory space right now. There's a lot of attention on conglomerates and large actors like FTX, but a lot of these systemically important players were not getting really addressed in the debate. And so these were gaps that we saw, and these were reasons why we took up the study.
Okay. Siju?
Yes, I think to further elaborate on what Tanvi has mentioned, and thank you for having us, is that I think we found it interesting seeing the traditional issues that we see that enforces financial crisis also occurring within the crypto ecosystem. And we have things like over leverage, we have maturity mismatches, interdependencies, and we also see that in the case of crypto ecosystems, these factors are actually amplified. So that was one of the things that we found very interesting and necessitated us considering this research. Thank you.
Okay. So over the course of, I mean, as you delved in, as you produced the paper, you delved into research on chain data. Were there any surprising findings when you looked into that?
Yeah, I think with the on-chain data, there were lots of surprising findings. I think so, whether it's in terms of how these different entities were managing their own assets, or in terms of just how quickly a lot of these collapses precipitated, right? So you had, prices collapsing like 70% in a matter of like 10 minutes, and then cascading down further over the next week or so. These kind of things have, very difficult to see in traditional finance because there's been so many decades of regulation which fix these kind of issues, right? So I think in terms of on-chain data, and the whole period of study that we had. So we actually did a 3-month study on this, right? So we had a team of legal researchers, we had engineers, a fairly global team that worked on it. And there were 4 to 5 major issues that we saw thrown up from the data. And this report focuses on the first one of those, which is interdependencies. And as you said rightly, Ajay, there will be further reports which examine the other causes going forward.
Yeah. Can you give us any, I mean, not to get into necessarily the meat of those reports, but can you provide us with any telltale signs, previews, coming attraction, indications of coming attractions that people should be aware of in terms of what else you're producing in terms of literature?
So absolutely.
Yeah.
Yes, because well, one of the things that we're able to explore is the idea of the internal structure, risk management dynamics within the crypto ecosystem and how this affects the broader ecosystem's market integrity and stability as a whole. So apart from the idea of examining how interdependencies have played a role in the progress efficiency as well as risk contagion within the system, we are also interested in finding a sustainable regulatory framework that can help promote efficiency, financial inclusion within the ecosystem, while also guaranteeing public policies like financial stability, consumer protections, and investor protections too within the market. So for what our future projects might look up to, we are considering the implementation of proposed regulatory approaches within the context of crypto ecosystem, as well as the overlap that it has to traditional financial regulators.
Interesting. So a new wrinkle on what was being said in the aftermath of 2008. And to come back to your point about a more stable regulatory system, it's long been said most markets, and I think Professor Arner would agree, most markets are in a state of flux, and most markets are in a state of disequilibrium. And that's also true the financial realm, where regulation is not always all-encompassing. And when you're dealing with new things like crypto, relatively new things, regulation is often ad hoc. It's a patchwork quilt. So with that in mind, what gaps do you see in the regulatory process that prompted your investigation?
Yes, I think one of the things that is very critical is the idea that, like you mentioned, the inefficiencies in traditional financial regulatory atmosphere at this time is that it's mostly reactive as opposed to prophylactic. But right. Prophylactic could be possible if there is a quick analysis of a risk-based approach. But to have that, you need to be able to plug data gaps that can come from first understanding the dynamics of the market. Now, and like Tanvi rightly said, us having the opportunity to research on and exploring the on-chain data has given us an opportunity to see how, or to highlight some of the intricacies that we have within the crypto ecosystem that we believe, if it's leveraged, could put us at the vantage point to better regulate the crypto ecosystem. So as opposed to just reacting to crisis after crisis, financial crisis will always reoccur, but how we manage or better prepare the stability of the systemically important participants within the market will determine how far or how critical the effect of the crisis will have on the ecosystem and the associated financial systems.
Okay. I mean, Tanvi, did you want to chime in?
Yeah, I think in terms of gaps in the process, one of the major ones that we see is exactly as you said, there's a quick rush to arms, in terms of building a framework. But I think there's not often enough time put into, deliberating what really went wrong, right? And I think in crypto, that is harder because it's a very noisy ecosystem. I come from fairly deep in that ecosystem, and Shuju comes from more of the, traditional regulation ecosystem. So I think we were able to marry in the study a good balance between the two, right? So I think it's very important that going forward, now that crypto has become a fairly large sector, right? It's important that the regulations actually work, because there are a lot of risks to people, to institutions from things going wrong.
Yeah, I mean, and to your earlier point about Mt. Gox did not have that much of an impact. Well, because at that point, many people still looked at crypto with a skeptical eye. I mean, they weren't chasing alpha. They weren't seeing the mad cap returns. Many people still at that time regarded it as a scam. Not as many people were invested in it. And as to the point about being forward-looking and taking perhaps a more prophylactic approach, I think really what's more needed is, rather than a lawyerly compliance officer, let's look at things after the fact, and okay, based on what's happened before, now we chart, our plans for the future to avoid this in the future. I think probably more of a, again, forward-thinking financial risk management approach is probably more in order, and that's long been the debate. People are using compliance to do risk management, but on the matter of the major guiding frameworks, I mean, what are the major guiding frameworks do you think that are driving how crypto regulations will be shaped going forward? Because it's often said the commercial activity takes place, and then the laws and regs follow. And it's typically when the market gets out of control and can't regulate itself, and there are abuses and people get burned, that's when there's a clamor for the state to get involved and regulation to ensue. So are we going to see a similar dynamic for crypto?
Okay. I think for that point is we see within the framework of cryptocurrency, crypto ecosystems, that there are causes for amplified prudential regulations. We see the recent publication by the IMF on the guiding and elements of effective crypto regulations, that we see different aspects that shows a very strong verisimilitude between traditional financial risks and the applications within crypto ecosystem. What will be the guiding framework of this? I think it would be how much of this prudential regulation can be effected within a relatively underregulated ecosystem like crypto. Now, you must understand that apart from the traditional financial providers that are also having a minor play at this time within the crypto ecosystem, how much of this new regulatory framework is implementable within DeFi ecosystems? If we are able to find out how we can put it in the sort of embedded regulations, embedded supervision, we think it will go a long way in creating efficient ecosystems. But until that is done, one of the critical things that we opine must be focused on is how to explore the intricacies within the crypto ecosystem and marry it with what we know in traditional financial regulatory systems.
Personally, Siju, I think you're going to see both. I mean, you're going to see the top down. I mean, with people, the FSB, for example, they're more concerned about long-term macroeconomic risk stemming from crypto, and that's important too. That shapes the regulatory agenda.
Yes.
But what you also see is at street level, when retail investors get burned, and it happens to enough people that there's a hue and a cry, more bottom up. There's a hue and a cry for regulators to do something. Yes. And I think you're probably going to see both those pincers shape regulation. Tanvi, did you have any thoughts on the frameworks and the the prevailing political winds shaping crypto?
Ajay, like I'm an engineer by background, so we are trained to have first principles thinking, and I think that's very much needed. I think that's what's needed right now in the way that regulations are being shaped. And I think the real challenge comes from, we need to be very cognizant of where are the real structural differences in crypto, right? So I think, as you pointed to DeFi, I think that's a well-recognized gap that, you have this issue in identifying intermediaries. Even if you do identify intermediaries, you have issues in enforcing anything, right? So I think there are these proposals of embedded supervision or other ideas, right? But I think one very massive difference in crypto compared to traditional finance is you don't have any lender of last resort, right? So if you have a contagion like you had in the 2008 financial crisis, you can't do something like a TARP, or you can't do an intervention like that, right? Like when things fail, they fail because there simply isn't that sort of a structure to it, right? And that's why I think structurally crypto has had these abnormalities, because it doesn't make sense for there to be so many derivatives in crypto, right? When you don't have a lender of last resort, like how do you even think of managing risk in something like that, right? So I think there are these structural components that should be at the forefront of thinking, right? When regulators are drafting these frameworks. And in terms of guiding frameworks, at the moment, it's very much the focus. We just came out of G20 in India, like the finance ministers meeting just concluded a few days ago, right? And I think the focus is very much on there are the IMF guidelines. There are now these FSB guidelines that are coming, but these are very broad guidelines, right? Like what actually has to be implemented is still a bit of a question mark for every country, right? Like, so you might make a guideline saying that you need to have a licensing framework for exchanges, right? But what exactly that framework should be is like, there's no proven model. Like you have some models from Japan or from other countries, right? But which ones have been successful, which ones have not been? I think there's so many of these questions, right, which need to be answered for us to get somewhere in effectively regulating crypto.
Yeah, that's interesting. I mean, as far as the G20 meeting went, I don't believe they issued a joint unified statement this time, so
they didn't focus much on crypto in this session. I mean, there was just a panel of sorts on the side, but there was no real deliberation this time. I think those are saved for the next meeting.
So, with all that you've learned over the course of putting together the report, what changes do you anticipate in the crypto ecosystem going forward? We've talked about the regulatory side. I don't know if you want to talk about the business and the technology side. What does the future hold? What do you see happening?
Well, okay. I think one of the things that Tanvi highlighted in last observation is that we see a lot of microeconomic considerations within the crypto ecosystems, a lot of excitement from global regulators. But one of the other things that we see is that the crypto ecosystem is also interested in gaining legitimacy from the broader financial ecosystem. Now we are having strong adoptions of crypto related activities by retail investors, like you mentioned, and even institutional investors increasingly now. So what we see will be the way forward is how to internalize efficient risk management structures, how to internalize traditional financial regulations in the context that does not overcome the dynamics of the crypto ecosystem, because, so to speak, that is the selling point now. But balancing the market efficiency that so far risk arbitrage has offered with the need to protect consumer protection and market integrity within the crypto ecosystem is one thing that must be factored in to the future of crypto ecosystem. So as much as you want to remain viable, you want to remain profitable, there must also be assurances provided for the participants within the crypto ecosystem. Like Tanvi said, in the absence of a lender of last resort that we have in traditional financial regulations.
So then, if I understand what you said, because I mean, some of this is above my head, that you see crypto as a vehicle to foster better risk management and consumer protection, and thereby improving the overall financial space. Is that a fair statement, or is that overstating the case?
We are seeing strong overlap between the crypto ecosystem and the traditional financial ecosystem. Now, one of the things that we see is that there is still substantial lapse in the application of risk management structures within the crypto ecosystem. If we are able to attention our policy orientation towards this, then we have a stronger chance of leveraging the crypto ecosystem in driving public policy goals like financial inclusion, market integrity. There is a strong tendency that crypto will continue to have a significant role to play in the global traditional financial system. So I think it is wise that we also factor in, make sure that the ecosystem is efficient and viable with strong provisions for consumer protections to ensure global stability.
Let's pick up on that, on the topic of internal risk management practices and crisis control systems in crypto. Are they inadequate or what? I mean, because you spoke of lapses, or is that not a uniform statement? There are lapses at some entities and not so at others. I mean, could you flesh that out a little bit more?
Okay.
Because people want to know where do the deficiencies lie.
Okay. Yes, I think one of the major things with that is that we see a microprudential internal framework trying to deal with macroeconomics risks.
Right.
While we are having microprudential effects, as we've seen with the crypto winter period, the institutional frameworks that we are seeing that is available at this time is like we have the stability mechanisms and the risk management practices that we see in most crypto ecosystem participants, as well as the framework is still largely focused on microprudential. So trying to ensure that institutional stability is ensured within single or maybe a conglomerate. But the problem is we have not just duplicity, but multiplicity of financial functions. When you have that, you have risk contagion and risk pollination between different sectors of the financial ecosystem in the crypto world. So while you might have strong risk management practices that is attendant to your primary obligation as a payment system provider, what does this have to do when you are exposed to risk from the securities sector? Securities, investment, and the other key sectors in the crypto ecosystem. So we tag this in our research as unknown risks, or well, you can even call it unacknowledged risks, because if you have exposure substantially to these entities as a result of over leverage, the way we see with the concentration of reserve in 3AC and the effect that it had on crypto participants like Celsius, BlockFi, FTX itself, and the others. How do you protect or ensure the stability of your institution, as well as protect the investors and consumers within your ecosystem from these extended risks? That is what we are interested in.
Yeah, I mean, many suggested that. I mean, if we look back to the global financial crisis and the quote unquote learning curve that happened in 2008, 2009, many suggested that regulations tailored for banks may not necessarily apply to crypto. I mean, we heard similar such claims over capital adequacy of the Basel Accords being applied to non-banking financial institutions post 2008. That it's understandable that maybe banks and insurers need to maintain more than they need to, but should that apply to everyone else? I mean, the adopting a homogeneous approach to all financial institutions, it said, is counterproductive, and some in the crypto community would argue the same.
Okay. Yeah, I think this. I mean, I can speak more for the way that crypto firms themselves manage risk, and I think in terms of banking regulations, there's a fair amount we've seen just in the last quarter, right? So you've had the New York DFS guidelines on that. You've had Basel Committee come out with this 2% holding. Yeah. But the challenge remains consistently that are they really addressing the problem where it lies, right? And I think your question on risk controls in crypto was very good, because they are sometimes almost non-existent, right? So I think it's not even just poor. I mean, where are the benchmarks? Where are the systems to handle that, right? Because if you see, there were exchanges we looked at which probably don't even have a sort of daily or real-time snapshot of their asset health, right? Because, everything in terms of where the price feeds are coming from, which market's actually setting the price for a certain asset, a lot of that can be manipulated for a whole class of assets, right? Like
completely. We saw that with real estate in the US, that too many banks were holding properties that they refused to mark to market post 2008 because the 18 months immediately thereafter, because otherwise they would see record losses.
Yeah. So, and it's not just that, it's just that these systems are so underdeveloped and there's such few benchmarks, right? Like, so even if you see these crazy interest rates that, crypto products were giving, well, what are they based on, right? There's no benchmark rate. There's no way for these guys to structure those products. There were, I think when we were seeing in the case of Anchor, for example, right, or with the Terra crash that happened, it was precipitated, in large part with Anchor. And I think there were a lot of people from the beginning said that, hey, this is completely unsustainable. I mean, how can you offer like 12% APY and there are these recurring bugs in the code which help you, like there's certain apps which let you do recursive lending out of Anchor, and that whole thing crashed at the end, right? So I think there are issues in just how you are setting things in this entire business model, right? So it's not I think nailing down the risks in this is by itself a big task. And I think we embarked on this with the study, but I think it's a much bigger task that's not being given due attention.
Yeah, I mean, I think your paper's aim, as I understood it, was to identify key drivers of, crypto contagion that should inform how regulators approach things moving forward. So looking back on the global financial crisis and the notion of systemically important financial institutions, or SIFIs, that arose from that for guidance. I mean, there exist clear parallels when it comes to the interdependence between SIFIs in the context of crypto and conventional finance, as Sijuade pointed out. as the paper makes clear, many of the traditional provisions from traditional finance can be useful, and regulators and policymakers should address those risks posed by crypto. But again, I guess that they'll have to sift through the rules, and discern what is applicable. Not do a copy paste job and say, okay, that which is true of securities is true of banking, is true of insurance, is true of futures, because that's not the case.
Yes, like you mentioned, after the aftermath of the global financial crisis, one of the very radical policy paradigm shifts that we observed is the move towards macroprudential regulation as well as strong entity-based regulations. So we see the designation of CFIs by the FSB's mandate, but we have seen is that even in traditional financial regulations that we are seeing a shift from entity-based towards activity-based and cost-benefit approaches towards macroprudential regulations. This is because of an identification of the dynamics within the traditional financial system. What we have found from our study in the crypto ecosystem is that as much as we have activities going on, similar financial activities to the traditional financial system, we see that the risk is actually amplified by the entities that are.
That's intriguing. Yeah, that's intriguing. That they themselves are bringing about the risk that they will fall prey to.
Yes. Yeah. So we see that the entities within the crypto ecosystem are significantly important. Now, the rules as it applies to the choice between activity-based and entity-based is where the activities are significant enough that can cause financial disruptions or distress throughout the ecosystem, then an activity-based macroprudential regulation approach is favorable, is desirable. But as in the case in crypto ecosystem, we see that it is in fact the entities, because like Tanvi mentioned, within the DeFi ecosystem, although we have system-based interdependencies, like in our report, we mentioned the Mango market crisis and the tendency towards unscrupulous manipulation of the underlying smart contracts and Oracle framework to the benefit from the lapses in the protocols. But to a larger extent, the risk has been propagated by entities. So that is why we are of the opinion that if there are risk management frameworks and practices concentrated in this systemically important financial actors in the crypto ecosystem, we have a higher chance, in our opinion, of reaching the risks in the activities that are strongly engaged by them.
So coming back to how prudential regulation needed for systemic macroeconomic risk, would you envisage then that for crypto, regulators might say, okay, as people point out post 2008, you've taken on too much in the way of futures contract risk. You need to unwind some of these trades. Could you actually see regulators saying that to people in the crypto space? Because there is a less so now, but it was more so a decade ago.
Yeah, I could comment on this dynamic between regulators and the crypto industry, right? Because I think that's one I've seen quite closely now over the last few years. I think till regulators find real, hard solutions that can help them with enforceability, they will keep seeing this evasion of rules. And I think, as you were asking earlier as well, in terms of how the industry will change after this period, like you're already seeing that change in a massive way. Like there's been overwhelming shift towards DeFi. The DeFi ecosystem is building up infrastructure very quickly. In all the years that I've been in this space, like I've not seen this much focus on core infrastructure, and this infrastructure is going to sort of network the DeFi systems much more deeply than they have been ever before. It's going to be much more easy to move assets cross-chain, cross-system, build multi-chain financial products and all of that. So I think, the tech community on this keeps moving, and we've not seen that activity slow down really after the contagion. So the asset prices may be down, but funding is still going in at large quantities. Building is still happening at very high speed. So I think the faster regulators figure out ways to enforce things, the better it'll be. So I think building the rules alone is not going to be sufficient in crypto. That's something as a think tank we've been very clear about from the beginning.
Not just drafting the rules. Yeah, not just drafting the rules.
Unless you have tech-based solutions, it doesn't matter. Like, it's just very easy to just avoid any compliance, and nothing would happen, for years unless there's a proper enforcement.
You can't be a de facto or stealth member of the financial system and not be subject to regulation, because back then they were saying, no, crypto's not a currency. It's a payment system. It's a peer-to-peer network. It's all three. It's not just a messaging system. It's not just a payment system. It's not just a digital commodity.
Yes.
It is a currency as well. And so with that in mind, has it dawned on people ultimately that crypto cannot be a fringe player on the outskirts? It needs to be brought into the mainstream regulatory apparatus.
I think one of the stuff that we were able to identify from our explorations of the drivers within the crypto ecosystems interdependencies is that we see similarities between the traditional finance and crypto ecosystem in the context of technological innovations and even financial consolidations driving increasing interdependencies. And why I pointed to that is that we see the emergence of crypto conglomerates. So what the argument will be back during the problem of empty goals in 2013, 2014, that we have them operating in singular sectors and not in need of the comprehensive, maybe rig fencing or the stronger policy considerations that we see after the global financial crisis may not necessarily apply now, because in the context of crypto conglomerates, they are operating in not just in multiple financial sectors, but also across borders. So we have them having strong implications, not just in host countries, but in other countries that has internet access, and consumers or investors can have an opportunity to jump onto it. So are consumers seeing this? Yes, of course, we see that the institutional investors as well as the retail investors are getting affected by the recurring crisis situation, as well as the commingling of funds, like we see with the FTX and the higher prospect for market misconduct and crimes, as in addition to technological risks. Now, do they crave this? We could make a broad guess and say maybe there are two proponents. One from the techie side. Do the techies want strong regulations in the context of financial regulations? Then you have to explore what their opinion is of the advantages inherent in regulatory arbitrage. Because as much as the crypto will remain underregulated, there is room for development in the prospect of people who are proponents of the dynamics that we have for crypto at this time. But there are also the others that are trying so much to integrate crypto ecosystem into the traditional financial ecosystems. For this, legitimacy is important. And one of the ways to get that is through proper and adequate financial regulations. You need to get legitimacy from the traditional financial regulators for you to get the pool of investors or traditional financial investors and traditional financial consumers. So you don't just have people who are exploring or taking higher risks than rent necessary. So I think going forward, there could be a meeting point between these two groups, and that will determine how far crypto is able to go into the broader financial ecosystem.
You think it's possible that there will be a meeting point, that you can bridge the gap between crypto and traditional finance? Because again, this debate's been going on now for over a decade, and it goes back to the roots of Bitcoin, when at that time, again, you had the purists saying, no, don't get the banks involved, because if you do, the actions they will take will be anti-consumer. They will use the technology to their own ends. Any savings will end up in their pockets and won't be passed down to depositors and the their clients in general. Then you had the other side, put forward by Bobby Lee from BTC China, which was, if you want crypto to be respectable, it'll never eclipse mainstream finance, but if you want crypto to be respectable, if you want mainstream acceptability, you've got to get the world's major banks involved.
Yes.
Yeah. I think I'd like to comment on that, because I think it goes back to something that I've held for a long time, which is that crypto's rules are actually going to be decided in the theater of policy, right? Because I think they actually need new legislation, you need new rule making, right? And I
it's
think
a politically charged issue. That's why I think you're right. It's going to be decided in that arena.
Yeah, and it's so regulators can only go so far, and I mean, there are limits to their mandates, right? And I think they're doing what they're supposed to do, which is take their risk frameworks and apply it here. But what crypto actually needs is new rule making, and I think that's been very evident to any deep regulatory watchers that I've seen. Even in DC when I was there, most people were of that view that we need new rule making. Most regulators also of that view. It's basically been sort of pushed down to their plate, and I think they've done what they could. But I think now the game is very much turning, and I think you see since last year, the Biden administration has begun, like the White House has finally stepped in, and they've started this all of government approach into looking into this issue, and I think that is going to change a lot of things. A lot of countries, this issue has come into these policy forums now. It's getting escalated to those forums. And I think that's where the actual trade-offs on this thing have to be decided, right? So it's one, regulators can only grapple with, making this safe as an asset class, or, making it risk-free or low risk as an asset class. But this bigger debate that central banks have, right, of just how much we need to allow this, how easy or hard you need to make this, what is it that you want to drive this ecosystem towards, right? Like, what is the efficiency we want it to bring? What is it we don't want it to bring, right? Like, these are the larger policy questions I think have been sort of evaded for some years, and I don't think they will be anymore. So I think this year and the next one are going to be very significant.
No, that's a fair point, because market efficiencies sometimes run counter to long-term consumer interests. Yeah. So as you examine the role of emerging interdependencies and recurring crises cycles, and say that they've overwhelmed internal risk management protocols and created both known and unknown risks. I mean, if we talk about former U.S. Defense Secretary Rumsfeld's point about unknown unknowns when Iraq went to hell, that isn't it simply the case in the modern world? There will be financial crises from time to time. You can't envisage every factor, and that even in the best designed risk management systems, there will be gaps. Some areas will be patchwork quilts, and you end up having to patch those holes on an ad hoc basis, and at that point, you can't. I mean, some damage will have been done, but you're doing your best to mitigate the damage, to contain it.
Yes. We see finding a framework to marry market-driven developments as well as regulatory-driven developments in financial system is very critical. Now, what we see in 2014 till now is that there's been substantial market-driven developments. We see strong interactions between the global banks and also crypto systemic participants, as well as regulatory-driven innovations that we're seeing, frameworks for stablecoin arrangements, that is also, well, the more you regulate, the more legitimacy you give to those ecosystems. So as much as we are seeing from the regulatory perspective, we are seeing from the market perspectives, how do we marry this towards the future? It's going to be the critical aspect of the developments that we're going to see in the crypto ecosystem going forward.
Okay. In the time we have left, is there anything you'd like to share with the audience? Anything you feel we didn't cover? Either of you?
Oh, yes. I think I'd like to talk about some of the potential solutions that we explored in the aftermath of our research. Now, like I mentioned earlier, we were able to not just explore the drivers of interdependencies within the crypto ecosystems, that we were able to mention financial consolidation, technological innovations, and of course, the regulatory recalibrations that we are seeing in global financial systems now. But in the aftermath of these drivers, we were able to show the manifestations of contagion within the crypto ecosystem using case studies of crisis. So within the DeFi ecosystem, we see, and it was a very interesting process, because I'm very grateful to be collaborating with Tanvi on this, because she is very tech-oriented, so she understands the dynamics of the crypto ecosystem far beyond what you expect from a traditional financial regulator or regulatory enthusiast that I will call myself. That what we construe as system-based interdependencies in the context of the CPMI framework that we have may not necessarily apply within the crypto ecosystem. Now, we have things like cross-chain, blockchain-based assets transfer, and how it affects and how it has protected the vulnerability, cross-pollination within the crypto ecosystem for over leverage. We see technological risk of cybersecurity, hacking, exploits. Now, from those, we were able to identify that as much as this crisis occurred, the risk, contagion, and financial distress that they communicated is what is really affecting the crypto ecosystem. And of course, the consumers, we are having bank runs, crypto runs, investor losing confidence. Well, one of the reasons is because we don't have the lender of last resort framework that we will have in traditional financial systems. So to this, we do not have any wishful thinking that there should be a lender of last resort, at least at this time. We are trying to work with the existing framework or the dynamics that we have, the crypto ecosystem, which is how do we amplify or create a better, efficient, and effective risk management framework within the crypto ecosystem as it is presently constituted. So 3 approaches that we found is that, one, there must be a broader risk perspective. So now we are making provisions for not just the known risk, but the unknown risk that is arising from the interactions between systemically important crypto actors, as well as the ecosystems in which they operate. So if you're a systemically important actor in payment, you must make considerations for your interactions or asset leverage in the asset management sectors, the investment and securities. The second is that we see there has to be a recalibration of the risk management practices. So there has to be a shift from the microprudential considerations toward macroeconomic implications that we are seeing. How do we put this? We are seeing that since there are strong interactions between these parties, there is opportunities for stakeholder engagements within the crypto ecosystem. We are seeing fantastic results of that with corporate governance. If you look at the UK corporate governance code and the comply or explain multiplicity that we are seeing, the duplicity in global ecosystems. I think the last one, the third one, is that we are trying a framework for peer learning and coordinated governance within DeFi ecosystems. So of course, this is where your argument of involving technology developers to operationalize better risk management within technology-oriented ecosystem. I don't know if Tanvi will want to speak further on that.
Well, certainly I think what you're advocating is more of a, in the crypto context, more of a self-regulatory model. Would that be a fair statement?
Well, the self-regulatory could be one of the words, but now remember that we are trying to transpose some of the policy calibrations that we have in traditional finance and trying to put it or incorporate it in the context of crypto ecosystem. So we have frameworks for, one of the policy permutations that we're seeing now is to increase strong risk management frameworks within the crypto ecosystem. We agree that traditional financial regulators do not understand the dynamics of crypto ecosystem to amplify this. But if there is a framework for coordinated supervision or developments or recalibration of practices within the crypto ecosystem, then these data gaps can be better highlighted for financial regulators to find a way forward from. Otherwise, we will keep playing catch up or reactive policy implementations.
Fair point. Tanvi, your thoughts?
Yeah, I think it's very well summarized by Shiju, and I'll just say that we are going to come out with other reports in this series. So this one looked at interdependencies, but we are going to look at corporate governance. We are going to look at business model issues in this space. Risk, actually on risk itself, there's going to be a separate paper. So thank you very much for giving us this opportunity, and it's been a pleasure working with the Hong Kong University and with Dr. Arner.
Well, I appreciated that, and that brings us to a close. Please find the paper in question on Policy 4.0's website, and that you can download it there. And also please subscribe to www.hkufintech.com. Again, that's www.hkufintech.com to keep up with developments on our end. And to our viewers, thank you. Until next time.